This is what happens when you actually try to buy one of the giant steel boxes that move the global economy. A brand new mid-size container ship will run you somewhere between $50 and $90 million, while an ultra-large container vessel, one of those 400-meter monsters, sets you back around $260 million as of early 2026. People do this every single day all over the world, moving trillions of dollars of cargo across oceans on assets most of us will never see up close. But the whole process is so strange, so loaded with legal quirks, flag registries in landlocked countries, and boom-bust price swings that would give a casino operator a headache, that by the end of this video, you might decide it's easier to just keep ordering things off Amazon and let someone else deal with the paperwork. Let's start with what you're actually buying, because just like the airport tiers or the gym tiers we've walked through before, container ships come in sizes, and the size you pick is really a different business entirely. Ships get measured in TEU, 20-foot equivalent units, where one standard container counts as 1 TEU. The smallest ships, called feeders, carry under 2,000 TEU and shuttle cargo around regional ports, the workhorses of short-haul trade. Above them sit the Panamax and post-Panamax classes, sized specifically to fit through canal locks, and above that, the new Panamax ships built for the expanded Panama Canal that opened in 2016. At the very top sit the ultra-large container vessels, the ULCVs, carrying more than 14,500 TEU. The largest ship in the world right now holds over 24,000 TEU, stretches almost 400 meters, roughly 4 football pitches laid end to end, and stacks containers 26 tiers high. She was built in a Chinese shipyard, delivered in 2023, and runs nearly 200 feet longer than a typical aircraft carrier, which tells you everything about the scale of the asset you're considering. So where do you actually go to buy one of these things? You head to Asia, because that's where the entire industry lives now. Chinese shipyards alone built over half of all new vessels globally in the last full year of data. South Korean yards built roughly a quarter, Japanese yards a smaller share, and European yards barely register anymore. The major builders carry names like Hyundai Heavy Industries and Samsung Heavy Industries in South Korea, and a handful of massive state-linked yards in China. Here's the catch though. The order books are so backed up right now that new contracts are quoting delivery dates years out, sometimes stretching past 2028. Industry executives have publicly warned buyers that a delivery slot that far away doesn't look appealing at all, and that anyone signing a shipbuilding contract needs ironclad refund guarantees in place in case the yard slips even further or the market shifts underneath them before the ship ever touches water. If waiting years for a new build sounds unbearable, you can always buy used, and that's when things get genuinely wild, because the second-hand container ship market has behaved less like a shipping industry and more like a meme stock over the past few years. During the depths of the pandemic lockdowns, a small feeder ship sold for around $4 million on average. Just 1 year later, that exact same class of ship had quadrupled in value. At the absolute peak of the market madness, a major carrier paid over $100 million for a 12-year-old vessel that would have been worth a fraction of that just months earlier. Then the music stopped. Within about a year, a 20-year-old mid-sized ship had lost close to 70% of its value, leaving anyone who bought at the top holding an asset worth pennies on the dollar. Then geopolitical disruption in the Red Sea forced carriers to reroute entire fleets around the southern tip of Africa. Ships became scarce again overnight, and prices climbed right back up, with mid-size container ship values jumping another quarter in a single year according to shipping data trackers. If you want a lesson in how brutal asset price cycles can be, this market delivers it every few years like clockwork. Once you've picked your ship, you actually have to buy it. And this is where most first-timers realize purchasing a vessel looks nothing like buying a car or even a private jet. You hire a specialized shipbroker, a handful of firms that dominate this niche entirely, and your broker negotiates the deal on your behalf. Once both sides agree, you sign a memorandum of agreement, almost always built on a standard global contract template that originated in Norway and has barely changed in structure for decades. A 10% deposit gets paid within 3 banking days, after which you inspect the ship, review its classification records, verify every safety certificate, and prepare for closing. The closing meeting itself sounds like something out of a spy film. Everyone gathers dockside or on shore, the seller issues a formal notice of readiness, you wire the remaining 90% within 3 banking days. Both parties sign a protocol of delivery and acceptance, and the ship must be handed over completely free of any existing charters, mortgages, or maritime liens. And just like that, you own a 50,000-ton steel object floating somewhere off a port you may never actually visit. Here's the catch, though. You can't just sail off into the sunset, because your ship needs a flag, and this is where the business turns genuinely bizarre. As of the most recent data, 3 countries alone, Panama, Liberia, and the Marshall Islands, account for nearly half of the entire world's shipborne carrying capacity, registered under their flags. Liberia by itself hosts the largest container ship fleet on the planet, by gross tonnage. The reason is simple. These are what the industry calls flags of convenience, charging minimal taxes, applying lighter labor and safety regulation, and letting you crew the ship with sailors from anywhere on Earth. Roughly 3/4 of the entire global fleet flies a flag from a country that has nothing to do with who actually owns the ship. Liberia's registry alone generates a meaningful share of that country's national income, and it's administered not from Monrovia, but out of an office in Virginia in the United States. The Marshall Islands Registry is run out of Virginia too, managed by a private company that takes a fixed cut of gross registry revenue. And then there's the strangest case of all. Mongolia, a landlocked country whose capital sits over 1,000 kilometers from the nearest ocean, has operated its own ship registry since the early 2000s, administered out of an office in Singapore, and has registered well over 1,000 ships, generating a modest but real annual income for a country that owns not a single mile of coastline. International maritime watchdogs have flagged Mongolia's registry repeatedly for poor compliance, while Panama, Liberia, and the Marshall Islands consistently score clean, which tells you flags of convenience are not all created equal, even within their own strange category. You have a ship, and you have a flag. Now you actually have to run the thing. A modern large container ship operates with a crew of around 20 to 25 people, most of them from the Philippines, India, China, or Eastern Europe. A Filipino captain on a major container line can earn somewhere in the range of $9,000 to $15,000 a month, while a junior officer might pull in a third of that. Most owners never manage the ship directly, instead outsourcing the entire operation to specialized ship management companies that between them employ tens of thousands of seafarers across hundreds of vessels. Then come the operating costs, and they add up fast. A ship's average daily operating expense, not even counting fuel, runs into the thousands of dollars every single day, and once you add bunker fuel and voyage expenses for a large container ship, the all-in annual bill can land anywhere from $20 to $50 million a year. Insurance runs through a completely separate system of mutual associations called protection and indemnity clubs, a little over a dozen of them covering roughly 90% of the world's ocean-going tonnage between them. The same system that absorbed well over $1 billion in claims after the Costa Concordia disaster. So how do you actually make any of this money back? You charter the ship out, and there are 3 main ways to structure that deal. A voyage charter covers a single trip from port to port. A bareboat charter essentially hands the entire vessel over to another operator to run as their own for a period of time. And a time charter lets another company hire your ship for a fixed period, at a daily rate, which is the most common structure in the industry. The big names moving global trade on the operating side include the largest container lines on Earth, and their daily charter rates swing with a violence that would make an oil rig owner nervous. A major index tracking container charter rates bottomed out during the pandemic lockdowns, then rocketed more than 10 times higher within about a year and a half, before crashing back down by roughly 3/4 within another year. This is exactly why the smartest play in container shipping isn't necessarily operating ships at all. It's owning them and renting them out to the operators who take on the operational risk. A category of companies known as non-operating owners, essentially the landlords of the sea, made this play brilliantly during the pandemic. While the big shipping lines watched their profits collapse by 60 to 95% as freight rates crashed back to earth, at least one major non-operating owner saw its adjusted net income actually climb because it had locked in long-term charters at the peak pandemic-era rates before the crash ever happened, exactly the way a savvy real estate investor locks in a long lease right before a market turns. Every ship eventually reaches the end of its working life, and most of them head to one of 4 shipbreaking yards in the world, in India, Bangladesh, Pakistan, or Turkey, where they get paid out per ton of steel and torn apart by hand on tidal beaches. The very first ship ever beached at what is now the world's largest ship graveyard arrived there entirely by accident decades ago, when a captain anchored at the wrong lighthouse and the crew simply beached the vessel the next morning rather than correct course. That accident is how an entire multi-billion-dollar recycling industry came into existence on a stretch of Indian coastline. Time to pull it all together and answer the actual question, should you actually buy a container ship? If you happen to have somewhere between $50 million and $260 million sitting around, an appetite for 10-year boom and bust market cycles, a tolerance for legal paperwork that traces back to 19th century Norwegian contract law, and a willingness to fly a Liberian flag, administered out of Virginia, on a ship potentially registered in Mongolia, then yes, you absolutely can do this. People have been doing exactly this for over a century, and some of them are now worth tens of billions of dollars, having started with nothing more than a single second-hand ship decades ago, before building an empire that now controls a meaningful share of all global container capacity. The good news is, the door is wide open to anyone with the capital. The strange news is that once you walk through it, almost nothing about how the global economy actually moves will ever look quite the same to you again.